In this video, we'll look at the comparison over the period 2012 to 2016 of the financial leverage ratios and profitability ratios for Kroger and Whole Foods. All right, we'll start with the financial leverage ratios because they're actually pretty directly related to the profitability ratios. And the most commonly encountered ratio is the debt ratio. The debt ratio is total liabilities divided by total assets. All right, you must recall, and you got to get it tattooed on your arm, the basic accounting identity: assets are equal to liabilities plus equity. Okay, and that's walking around knowledge. Assets are what you own. Liabilities and equity are where you got the money to pay for the assets. So liabilities is money owed to other people. So when we're looking at the debt ratio up here, total liabilities to total assets, it's the proportion of assets funded with other people's money. All right, and 100% minus this ratio would be the amount that's funded by equity, the owner's equity in the firm. All right, so what we see is a huge difference here. Kroger's runs about 82% of assets are funded with debt, as opposed to Whole Foods, which was down or under 30% when they started, but basically about a third liabilities and 2/3 funded with equity until 2016, and that's when the firm added that $1 billion worth of debt while simultaneously removing $1 billion by buying back stock and putting it in the treasury. All right, so we can see these by looking at the financial statements. If we look at total assets, well, let me go down to total liabilities and equity, because those are the same as total assets. About $30 billion in total liabilities, about $37 billion in total liabilities and equity, $7 billion here, $30 billion here. With Whole Foods, it's about half and half, about $3 billion of $3 billion of liabilities, $3 billion of equity. Add those together, you get about $6 billion in total assets. A far cry from where they were in 2002, when it was $1.5 billion of liabilities and close to $4 billion of equity. So Whole Foods increased their treasury stock from 2012 to 2016 by about $2 billion. Means they bought back about $2 billion worth of the shares they had previously issued. And at the same time, assets increased. So if you're reducing equity by buying back shares of stock, the retained earnings is going up because you're earning a profit. So there's part of the offset. But we could see that total equity has actually gone down. Total liabilities have doubled. All right, so that's increasing the financial leverage. Financial leverage is good in that it makes profitable times more profitable, but it also creates risk because it makes unprofitable times that much more unprofitable because you've got to pay interest expenses. If we go up to the income statement, the interest expenses were basically zero or too small to measure is what they were for the first 4 years here, and then you're looking at all of a sudden now you're paying $41 million of interest because they've added that $1 billion of long-term debt, and Kroger's paying about $500 million. So in terms of scale, they're really different. We also try and measure the impact of that by looking at the times interest earned ratio. Times interest earned ratio is operating profit or earnings before interest and taxes divided by the interest, which is the I in EBIT. So what we're looking at there is operating income, which is the same as earnings before interest and taxes. If you divide the operating income by the interest expense, that tells you how many dollars of income you have available to pay the interest. And it's 6 times and change for our friends at Kroger. It was basically as much as you need in all these other periods, and now we're still looking at $850 million available to pay $41 million of interest. So both firms are still comfortably above the threshold for paying their interest expenses. The cash coverage ratio is a similar ratio, but instead of just EBIT, it takes EBIT and add back the depreciation expenses, because those are non-cash expenses, and then divide that by interest. So operating income is net of depreciation expenses, which we don't actually pay anybody the depreciation. So by adding it back, you get a better concept of the cash flow available to pay the interest. And again, both firms are comfortably above it. The equity multiplier is related to the debt ratio. It's the assets per dollar of equity, and notice that it's higher for Kroger. They're mathematically related. The higher the debt ratio, the higher the equity multiplier. This gives you a measure of the liquidity, the leverage effect of using borrowed money. So if you multiply assets over equity times net income over assets, the return on assets, this gives you how much the leverage effect is from using borrowed money to increase returns to shareholders. All right, and that's pretty hefty there for Kroger. That's a fairly large number for anybody, and you can see that Whole Foods is a lot more conservative in their capital structure and in their use of financial leverage. All right, so how that works, if we look down here at ROA, the net income ROA, return on assets, which is equal to net income per dollar of assets. And then we have ROE, return on equity, which is the net income per dollar of equity. That's how much the shareholders earn per dollar of money that they supply to the firm. The impact of this equity multiplier, the equity multiplier being the assets per dollar of equity, if you multiply assets per dollar of equity times the return on equity, that's what it gets you here. So that's what we're talking about with this leverage effect. You only have a 5% return on assets here with Kroger, which is a lot lower than you have for Whole Foods, but because they use so much more leverage, it makes their return on equity up around 30% plus, which is twice the return on equity for Whole Foods. If you can borrow money at 3% and invest it in assets that are earning 10%, then you get to keep the extra money. So that's the impact of leverage. You can do too much of that, but you can also do not enough. Now, Kroger can get away with a lot of leverage simply because of the size and breadth of the company. The bigger you are, the less variability there's going to be in period-to-period earnings. Plus, in times of economic crisis, people do not stop eating food. They tend to maybe eat more. But Kroger's earnings are going to be stable over a dip in the business cycle. But by the same token, if you get a $50,000 bonus this year from work, you're not going to race to the grocery store and buy extra groceries. So Kroger will have less of a dip in economic recessions, but less of an increase in times of economic boom. So they can probably afford to take on more of this leverage. Okay, I say probably because you can afford to take on financial leverage up until the time when you can't. If we look at the gross profit margin, lower for Kroger. We saw that, or you can see that in the common size income statement. And Kroger has less profitability than Kroger. Kroger has less sales profitability than Whole Foods. But again, what investors are mainly worried about is how much did you earn relative to how many dollars I gave you to earn it with. So there are a lot of different measures in here. Kroger relies on volume. They have a higher sales per dollar of assets, so you do a lot more volume than Whole Foods. They don't make as much when they make a sale, but they make more sales. So it's sort of like it, which is better, making a penny on $100 worth of sales, or making a penny on $10 worth of sales. You still made a penny. All right, when we the next video that we'll look at, we'll actually look at our DuPont analysis, which breaks down the profitability, the efficiency, and the financial leverage to explain this difference in the return on equity between the two firms.